Imagine two people start investing at the same time. One is constantly searching for the next hot stock. Every morning they check prices. Every week they change their strategy. When a stock jumps, they want in. When it falls, they panic. The other person is doing something that looks almost boring. They invest consistently. They learn how businesses work. They accept that markets will fall sometimes. They don't need to know what the market will do next week. 5 years later, something interesting happens. The person who looked busy all along may have made very little progress, and the person who looked like they were doing almost nothing may have quietly built something valuable. That is one of the biggest lessons in investing psychology. Wealth is often built quietly, not quickly. As a beginner learning how to invest in stocks, this is incredibly important because the stock market can make you feel like you're supposed to get rich fast. You see someone talking about a stock that doubled. You hear about someone making money from a market rally. You see screenshots of portfolios online, and suddenly your own progress feels too slow. That's where psychology starts working against you. FOMO tells you that you're missing something. Overconfidence tells you that you can predict the next big winner. And instant gratification tells you that if your portfolio isn't growing quickly, you're doing something wrong. But investing doesn't work like that. Real wealth can be incredibly boring while it's being built. You might invest this month and feel like nothing happened. Then you invest again next month, and again. You learn. You improve your decisions. You avoid unnecessary risks. You give your investments time. And slowly, something begins to change. Your money starts working alongside the money you previously invested. That's the power of compounding. The difficult part isn't always finding an amazing investment. Sometimes the difficult part is staying invested long enough to allow a reasonable investment strategy to work. This is why beginner investors should stop asking, "How can I get rich quickly?" A better question is, "How can I become the kind of investor who can build wealth for decades?" Because the goal isn't to look rich next month. The goal is to build financial strength that can survive bad markets, emotional decisions, and temporary setbacks. So if your investing journey feels slow right now, don't automatically assume you're failing. You may simply be experiencing what wealth building actually looks like before anyone notices. Quiet, consistent, unexciting, and over time, potentially powerful. The market doesn't reward you for looking busy. It rewards good decisions, discipline, patience, and time. And sometimes the smartest thing a beginner investor can do is resist the temptation to do something exciting. Because wealth doesn't always announce itself while it's being built. Sometimes it simply compounds in silence, and years later, everyone suddenly wonders how you got there. If you want to understand the psychology behind smarter investing and learn how to invest in stocks as a beginner, keep learning, stay disciplined, and remember, you don't need to get rich quickly. You need to avoid quitting too early.